Dear students, we will be continuing from the previous lecture. Now, in the last lecture, we have discussed something on withdrawal rates, how these withdrawal rates affect insurance company in terms of their business. So today we'll start with the various factors which are relevant for an insurance company and which plays key role in determining withdrawal rates. These factors are listed as follows. Now, first factor that we have is withdrawal risk. Second is we can determine this fact based on past experience and industry experience. It can also be determined according to the type of product. Next element is like premium payment frequency. It also have an effect on withdrawal rates, followed by economic conditions, market conditions. Now, distribution channel used for selling products will also be playing a key role, followed by target market, financial awareness and knowledge level of the client. Also, the various geographical factors like rural and urban population covered, and it also includes what type of premium payment modes are available to customers, followed by competitive situation for this product and various terms and condition of the contract. So the one basic thing which you should keep in your mind while listening to this lecture is like this withdrawal rate estimation is very important for an insurance company. So if these are determined accurately, insurance company will not be going into any losses. But if there is any flaws or error in computation of withdrawal rate, insurance companies will be having drastic effect on their profitability. So it has to be done with a very conservative mindset, where you need to be a little bit hard on your estimations. These need to be a little bit pessimist, and pessimist observations are taken as a good indicator, like you're taking more of negative thing, and in this line keeping higher withdrawal rates and accordingly pricing your product is kept as an idle thing. Now, carrying on with this discussion further, we'll see to it next is like this withdrawal rate computation. If there is any error in it, will be affecting the shareholders of the insurance company. Now, shareholders are the owners actually of the insurance company. If a company is going to have extra cost and extra claim settlements, so it is going to affect the overall profitability, and ultimately it is going to affect the shareholders. So that is very important. Like any wrong decision on the part of actuaries for estimation of withdrawal rate will affect shareholders, so they need to be very careful dealing with this particular topic. Now, what is important is like you should have a best estimate for withdrawal rates, which is like accepted in industry by other insurance also. So that is first requirement. Second is like you should estimate this for future conditions, like it will affect your future. So these are withdrawal rates are meant for like futuristic time horizon. And last but not the least, your own experience as an insurance company will also play a key role to determine what type of withdrawal rates are applicable for your concern. Next thing, we'll start with the various factors. First factor which affects your withdrawal rate is like type of product. In this first example that we are going to understand is a term plan. A term plan is a plan which is mainly covering risk related to a client, and this product is something which is mainly purchased by people who are very much like skilled in terms of financial awareness. So everyone is not used to pick up this product. So in such a product where customer is very much aware that the policy is having a very low amount of premium but having a very big amount of coverage, so in such a policy where you don't have any surrender value, so chances of having withdrawals is very low, so is good. But there is a possibility like new term plans with attractive premium may have an effect on your withdrawal rates, so accordingly we need to think. Next is like next example in line to like what type of product will have an effect on withdrawal rate is an example of a unit linked product. In this, what is happening is like your product, which is an insurance product, is actually linked to stock market. So you do have your units. Now in such a product, what we have is like we do have something as surrender penalty. So it is applicable for first 5 years. Thereafter, there is no penalty. So it also gives a chance, like first 5 years there will not be any withdrawal, but fifth year onwards there will be withdrawal. So again, it is going to have an effect on your withdrawal rates. So according to the type of product, we do have certain things where we do understand that depending on what type of product you are dealing in, you may have different type of withdrawal rates. Now next point that we are going to have an effect is like we do have like past experience and industry experience. Now past experience is internal in nature, means this is within organization, and industry experience is somewhat outside to organization. So because we are looking into insurance sector overall, so when I say industry experience, it is overall industry related to insurance sector, how other players in industry are computing their withdrawal rates, because we are in same sector, so more or less same sort of withdrawal rates will be applicable across the companies. And whereas past experience means this is related to our own internal past experience dealing in certain types of product, like so your own experience is better than what others are suggesting to you. So accordingly, you do have certain dimension of withdrawal rates being affected due to your past experience in industry. So next is like you do have premium frequency. In this, what I try to tell you is like frequency of premium payment will also play a key role. Like if it is a one-time single payment premium payment policy, so in such a case, you see customer has already given you your premium, so there is no further obligation on the part of customer, so chances of discontinuance is low. Whereas another policy where you have regular premium payment, any monthly or quarterly or half yearly, in such a case customer has to repay it multiple times, and maybe a possibility that on certain occasions customer don't have funds, so possibility is there that they may not be able to continue and may be affecting their like discontinuance strategy from this insurance company, and maybe leading to withdrawals. So this is again one dimension of it. Next is like size of premium. So if it is a lump sum payment, chances are there that customer will not be willing to continue. If it is a small payment, it will not be bothering the customer a lot. So if it is high amount, then it is hard to afford and maybe leading to withdrawals. Now followed by next is general economic conditions. Now economic conditions means you can take an example of your current state where coronavirus has affected the market badly. Over last almost 10 to 15 days, stock market has crashed on every single day. Market is going nowhere, means heading downwards, is badly affecting the sentiments of customer. So even though your policy plans are good, but if they are market linked and then market is falling down drastically due to certain global factors or due to certain domestic factors, but if it is affecting your net asset value, so it is going to affect your customer psyche and may again lead to withdrawal rates by customer. So similarly, what there are two things which needs to be taken into consideration when it is economic situation. So first is like whether your people or consumers will be able to afford the policy which is ongoing, and second is like is there any sum assured, is there any surrender value which your customer will get, because in times of emergency customer will tend to withdraw policies because they are unable to afford their regular repayment of premium. So chances are there when customer is running into an emergency situation, they may be inclined to surrender their policy, and this is something what is going to affect their withdrawal rate. Now next point is what type of under this segment, again you do have different types of policies. Maybe regular premium term insurance. In this, what you have is like you do have regular payment of premium, and here term insurance is there. So there is no benefit of surrendering a term insurance plan because maturity value is only at your death. So if you discontinue, no benefit, so it will not make any major difference even though it is an economic downturn going on into market. Now followed by next policy, the single premium saving policy is there. So here you have already made the payment, customer has already given his all contributions. Now only thing left is like customer is going to get his benefit on a maturity date, which is on a futuristic concept. Now point is there ki, like if customer is going into any sort of emergency, chances are there customer will not wait for a future date, maybe asking for a premature withdrawal. So it is going to affect your surrender rate. So it's very important factor when it comes to determining of withdrawal rates. So followed by next, that is regular premium endowment assurance. Now in this, customer is paying you regularly. Again, point is there like if customer, see, I have given you my example where I've told you that I do have a LIC health insurance plan where initially, like it is almost 10 years plan where every month I have to pay 1000 rupee. And what is the benefit in this policy is like I don't have any maturity value. I do have a sum assured of 50,000, very nominal amount. But what is important is like in case I'm going into any medical ailment or any problem or I'm getting hospitalized, I will be reimbursed by LIC. So what is I'm supposed to get out of it is like every month whatever I'm paying it to insurance company, they're deducting an like a fraction of it under the name of operational cost, and then residual value is going into a fund. Now this fund initial few years was not having much of value, so I was not never inclined to get like my policy discontinued. But with the passage of time, now you see for last 10 years I have hardly taken 2-3 times compensation, means that is only a minute portion of my total fund available with the insurance company. So it is better like I should carry on with my policy for a longer term. Reason is like if I go into any sort of medical emergency, I do have a cover, so this cover can be used. So accordingly, now you have a regular premium endowment scheme where chances of withdrawal in initial year is more, whereas chances of withdrawal in later dates are low. Now next is like distribution channel. Now you see how do you get your product as a customer. You do have branch, you directly purchase it from branch. You may have agency model where you are interacting with an agent and they are selling it to you, and then you do have like online mode, directly you are purchasing it through online is e-channel. Now point is like when you have an intermediary, maybe possibility that your intermediary is the person who is guiding you what to do, what not to do. So if intermediary is getting good commission in a particular product, he may ask you or he may counsel you in such a way where you may be forced to change or forced to withdraw, not because of your own interest but because of your intermediary involved. So it is important that how a customer psyche is being affected through distribution channel may affect your withdrawal rates. Next is like target market means you see what type of target segment are you catering. Is it your HNI segment or is it your low income group or middle income group? So chances are there, see, in a high income group and middle income group, people can afford their regular repayments to insurance company in the name of premium. But when it comes to the lower income group, if there is a hardship and there certain times you do have an economic crisis type of thing, so there chances are high that they will default or will withdraw or surrender their policy. So you need to look into your target market. Accordingly, your product related withdrawal rates will be there. Now next is like you have financial awareness or knowledge of your client. See, as a person who is skilled, who is aware, who is knowledgeable, is updated on regular basis, like these types of customers will never be like defaulting on their payments because they know the repercussions. But on the other side, if you have a customer who is illiterate, don't know much, so they may have like certain defaults because they don't know how it will affect their policy. So knowledge level, awareness level plays a key role, followed by geographical location of your client. If it is rural is like what we consider rural in this particular paragraph is like rural people are less aware, less financially educated, so chances of discontinuance is easy and is commonly found in rural area as compared to urban area. People, they are like very much busy in their day-to-day life. They do have a good circle, they do interact through online channel, they do take so much of review. So in urban area, people like will not be discontinuing until and unless you do have a flaws in your product. And in such a scenario where you are dealing with competition, flaws are not possible. Now next dimension in which like we are going to look at is like what type of mode you are using for making your premium payment. It may be you are paying cash on counter, or it may be like you are making online payments by yourself, or it may be like you are regularly making payments through ECS. Yani it is a mode through which standing instruction is given, and like your customer account will be debited every month automatically without any effort of your client. So if it is like through check or it is through cash on counter, chances are there that customer may default, may not get time to visit your branch. But if it is ECS type of thing, so their chances of withdrawal are rare because customer has given a standing instruction. Money will be debited monthly without any like default if money is there. So people used to do it very carefully on their salary rates that ECS will come, and they do keep provisions for it. Now next dimension for which like we are going to discuss is your competitive scenario. Now you see, if your competitor products yani other insurance companies who are there operating in same market, they are bringing in better products at cost effective cost effective way, so the chances are there that it may adversely affect your company consumer base and may lead to withdrawal. So is important, you should be updated and should be staying at par with your competitors, if not less. Next is like terms of contract. Terms of contract means what terms and conditions are there. So it will again play a key role into your withdrawal rates. People will look into your, like you do have an understanding of free look period. So in during free look period, they do understand the policy. After investing their money, they do go through carefully about your various plus and minus in your policy. If they don't understand, customer don't understand your policy well, they do have certain reservations regarding your terms and condition, maybe chance like they'll not be interested in buying your product. So this is how you see insurance companies do have various factors which affect their withdrawal rate. This is all about today's lecture. Hope you have understood well. So thank you.